Gold, the metal that built empires and still shapes money today. Let me ask you a serious question. In a world of stock markets, real estate, crypto, AI, and trillions moving digitally every day, why does gold still matter? Why do central banks still hold it? Why does gold often rise when inflation increases? And why do investors keep returning to gold during recessions and crises? Gold is not just jewelry. It's not just luxury. Gold is one of the oldest financial assets in human history, and it remains one of the most important. Because gold sits at a very unique position in the economy. It is not a company. It does not produce cash flow. It is not a bond. It does not pay interest. It is not a currency issued by a government. Gold is something different. Gold is a global store of value, an asset that has been trusted across cultures and across centuries. And in this video, I'll explain the history of gold as a commodity, how it shaped economics and banking, how people made money trading it, where gold stands today, how you can invest in it, and what the future of gold may look like. And by the end, you'll understand gold not as a myth or a superstition, but as a financial instrument. So, let's begin. Gold became valuable for a very practical reason. It has the properties of sound money. It doesn't rust, it doesn't decay, it's rare, but not impossible to find. It's divisible, portable, and easily recognized. And importantly, gold is difficult to create. You cannot print gold. You cannot manufacture gold. Its supply grows slowly over time. That's one of the key reasons it became money long before modern banking existed. Thousands of years ago, gold wasn't just used for trade. Gold represented wealth, stability, and authority. In ancient Egypt, gold symbolized permanence and power. In the Roman world, gold coins helped finance expansion and maintain control over a massive empire. And as gold became widely accepted, it enabled trade across borders. Because once people agree on a single store of value, trade becomes easier, markets become larger, and economic growth accelerates. But gold also created a major economic reality. Control of gold meant control of power. Because gold was the foundation of financing. If a nation had gold, it could fund armies, build infrastructure, and buy resources. If it did not, it became dependent on others. This is why gold is connected to conquest throughout history. Now let's move to the next phase. As trade expanded across continents, merchants needed a way to exchange value between completely different cultures. Gold solved that. Gold became a true global commodity, not because it was beautiful, but because it was trusted. And trust is everything in finance. When gold flowed into a region, it increased the effective money supply. And when money supply rises faster than production, prices tend to rise. This is inflation. So even historically, gold influenced not only wealth, but the price level of entire economies. One of the most famous examples is Spain. When gold and silver poured into Europe from the Americas, Spain gained enormous wealth. But Europe also experienced rising prices. That influx of precious metals reshaped economies and shifted global power. So gold wasn't just an object. Gold was an economic driver. Now here is one of the most important transitions in financial history. At some point, carrying gold became impractical and dangerous. So people started storing gold in secure vaults and with goldsmiths. And in return, they received paper receipts. At first, those receipts were simply proof of ownership. But eventually, people realized they could trade the receipts instead of the gold. And that idea became the foundation of paper money. Then banks realized something else. Most people do not withdraw their gold all at the same time. So banks began lending out some of the gold they held. This created a system where paper claims on gold could grow larger than the physical gold supply. This is one of the origins of fractional reserve banking. And this is where gold becomes extremely important financially, because gold is one of the few assets that exists outside the credit system. Stocks, bonds, and bank deposits are all tied to the financial system. Gold can be held directly, and that's why it has remained relevant for thousands of years. Now, for a long time, many countries operated under the gold standard. This meant that currency was directly convertible into a fixed amount of gold. In theory, this created stability, because governments could not print unlimited money. But the gold standard also created limitations. The world economy grew faster than the supply of gold. Populations expanded, industries expanded, trade expanded. And when major crises hit, especially wars, governments needed massive spending. The gold standard restricted this, so eventually, most countries moved away from it, and modern fiat currency became the global norm. Fiat currency is not backed by gold. It is backed by trust. Trust in government, trust in central banks, trust in economic stability. So today, money is essentially a system of confidence. And this is why gold still matters, because gold is one of the only assets that does not depend on confidence in a government or a banking system. Now, before we continue, I want to quickly say something. If you listened until now, that means you genuinely enjoy financial education like this. So please subscribe and leave a comment. I answer to each and every one. Thank you. Now let's get back to it. Even today, gold is still held by central banks. This is not an accident. Central banks hold gold because it is considered a reserve asset with no default risk. Gold has no issuer. A government bond has an issuer. A currency has an issuer. Even a bank deposit has an issuer. Gold does not. Gold is a neutral reserve. This is why gold plays a role in monetary stability. And it is why countries hold gold to diversify away from currency risk. Now let's talk about how investors and traders historically made money with gold. Gold is not like stocks. A stock produces earnings. A bond produces interest. Gold produces nothing. So the way you profit from gold is through price appreciation. And gold prices are driven by macroeconomic forces. The biggest forces that influence gold are these. First, inflation expectations. When investors believe inflation will rise, gold often becomes more attractive because cash loses purchasing power, and gold is viewed as a store of purchasing power. Second, real interest rates. This is one of the most important concepts. Real interest rates are interest rates after inflation. When real rates are high, gold becomes less attractive because investors can earn strong returns holding safe bonds. When real rates are low or negative, gold becomes more attractive because holding cash and bonds loses value in real terms. Third, currency strength, especially the US dollar. Gold is often priced globally in US dollars. When the dollar strengthens, gold can become more expensive for the rest of the world, which can reduce demand. When the dollar weakens, gold often benefits. Fourth, geopolitical risk and recession risk. During crises, gold often performs well because investors want safety. So, one of the classic ways people made money with gold is buying during fear. Gold is often strongest when confidence is weakest. Another way is using gold as a hedge, not necessarily to make the highest returns, but to reduce risk. This is a key point. Gold is not always the best performing asset. There are long periods where gold underperforms stocks. But gold often has low correlation with stocks, meaning it does not always move the same way. That makes it useful for portfolio diversification. Now let's talk about how normal people can invest in gold today. You have several options. The first option is physical gold, coins, bars, and bullion. The advantage is direct ownership. You have no counterparty risk. You are not depending on a broker or a bank. But physical gold has costs. There are premiums, storage, insurance, and sometimes higher spreads when you buy and sell. The second option is gold ETFs. These are exchange-traded funds that track the price of gold. They are liquid, easy to buy, and easy to sell. They are a very common way for investors to gain gold exposure without storage. But the downside is that you do not hold the metal directly. You are exposed to the financial system. The third option is gold mining stocks. Mining stocks are not the same as gold. They are businesses. They can outperform gold when gold prices rise because mining profits can expand. But they can also underperform gold due to costs, management, debt, political risk, and operational issues. Mining stocks can be more volatile. The fourth option is balanced portfolios that include gold. This is the most common professional approach. Gold is often used as a stabilizer, usually in small allocations, not because it guarantees profit, but because it can reduce portfolio volatility. Now let's answer the key question. Why can gold be a good investment? Gold is valuable for several reasons. First, gold can act as a hedge against inflation and currency debasement. When money supply expands rapidly, gold can protect purchasing power over time. Second, gold can act as a hedge against financial crises. Gold often performs well when confidence in banks and markets is shaken. Third, gold is globally liquid. It is traded worldwide. It is accepted across borders, and it is not tied to one political system. Fourth, gold can reduce portfolio risk through diversification. However, here's the honest truth. Gold is not a guaranteed winner. Gold can go sideways. Gold can fall even during inflation if interest rates rise faster. And gold does not generate income. So gold is best viewed as a strategic asset, not a growth asset. Now let's talk about the future of gold, because this is where things get really interesting. Several forces will shape gold in the coming years. One is inflation and government debt. Many countries have high debt levels, and when debt is high, central banks often face pressure to keep interest rates lower. If inflation remains persistent, gold may remain attractive. Another is central bank buying. Many countries have increased gold reserves to diversify away from dependence on the US dollar system. That trend could continue. Another force is geopolitical instability. Trade conflicts, wars, and global uncertainty tend to support gold demand. Another factor is the evolution of digital money. Some people assume digital currencies will replace gold, but gold and digital money are not direct competitors, because digital money depends on systems. Gold does not. Gold can be held outside the internet, outside banks, and outside networks. So in the future, gold will likely remain what it has always been: a hedge, a reserve, a safe haven, a financial insurance policy. Gold may not be the fastest investment, but it is one of the most resilient. So here's the bottom line. Gold has survived ancient empires, wars, collapses, revolutions, banking crises, and currency failures. It has been money, wealth, power, and protection. And even in the modern world, gold still plays a role in the deepest parts of the global financial system. If you're investing, Gold should not be seen as a get-rich-quick asset. It should be seen as a strategic asset, a stabilizer, a store of value. And in a world where currencies are printed, economies shift, and uncertainty is constant, gold remains one of the few things that still feels timeless. If you enjoyed this video, hit like, subscribe, and comment below. Do you believe gold will rise in the future, or do you think the world is moving beyond it? Thanks for watching, and I'll see you in the next one.